Welcome back, everyone, to the Kingscrowd Podcast. I'm your host, Brian Belley from Kingscrowd. And at Kingscrowd, we bring data-driven clarity to the online private markets. So every week, like we're going to do this week, we cut through the noise in the online private markets to help investors and founders like you discover smarter deals, avoid hype, build conviction, and raise capital. Let's get into our topics for this week. So we're going to be talking about three things real quick. First, hot off the press, the SEC just recently released their report for regulation crowdfunding through the month of May 2025. We're just going to touch on a few things that investors and other people in the industry should be aware of around that. We're then going to talk about an asset sale that recently happened, what that is, how it's a different type of outcome for investors, and whether it's good or bad, and a little bit of the nuance around that. Thirdly, we're going to go into a deal review, which will be on Siren Biotechnology, a deal that is currently raising on WeFunder and that our investment analyst Teddy has been taking a look at. So real quick, just to kick off the first segment with news, the SEC put out a report through May 2025 that looked at regulation crowdfunding throughout the years. Now, you can get this if you go to sec.gov, but there's just 2 points we wanted to briefly touch on to make investors and industry participants aware of. This report, it's great. It has a lot of really good info. A huge caveat to be aware of is that it only covers Reg CF companies that have done Form CU filings. Now, when you do the calculation, I think the number of companies that do those filings is something like 35 or 40%. So the numbers that they report here for capital raised in some of the charts that the SEC shows is really only representative of about 30 to 40% of all the capital being raised in Reg CF. Why we tell this is obviously you can head over to Kingscrowd and you can see some of our charts. When we do the analysis, we have 100% coverage for Reg CF. So these numbers you can see top out around 500 million, coming down to like 350. Comparing that to the SEC report, it's only around 320 million and under that. So there's this huge chunk of data that is missing. I definitely appreciate what they're doing here, showing some trends that are still applicable, but feel free to check that out. There's some other good charts in this report. Again, you can get this from sec.gov. But as always, if you really want the complete data set, make sure you head over to Kingscrowd and you can check out articles like this 2024 investment crowdfunding stats. All right, let's go to the first segment. I'm going to welcome Scott Kitun to help talk through this, and then also our 2 Kingscrowd senior investment associates, Teddy and Léa. So welcome back to all of you. We want to talk about is a company called Hello Woofy. Now, the reason we're bringing this up is that a lot of investors tend to think there are 2 different outcomes for their investments. It either fails, right, liquidates, goes into bankruptcy, goes completely out of business, or you get this huge resounding success. You have an acquisition, an IPO. A lot of situations where you're going to find is that companies have these kind of gray outcomes where maybe they get acquired by another company, investors get bought out. It's not a great outcome necessarily, but Hello Woofy is one that recently announced an asset sale on their WeFunder page. So we wanted to dig into that. Scott, I'm going to turn things over to you to kind of kick off the discussion here, but what do you think about this just in terms of Hello Woofy, but also in general when companies are looking and doing asset sales as an investor, how do you consider what's going on there?
Well, first, I want to congratulate everyone here on the color coordinating. Teddy and I representing green and Léa and Brian staunchly in the blue corner. It looks like we planned it. Hello Woofy. So I actually had the founder CEO, I think it's Arjun, is that right? I had him on my show on Technori like way back. I mean, like right as he was going, I think he wasn't even totally live with this campaign yet. So getting it, like have familiarity with the company and the guy. The company has evolved 15 times over its life in some way, shape, or form, which is probably not surprising that we've ended up in this spot. You asked the direct question of like, what do you think about these asset sale type things? I do think you teed it up perfectly in the intro, that people just expect like it's doom or gloom and boom, it's going to be a big success or it's just, over. And it is like so rarely the case. In fact, more often than not, nothing comes of it in the sense that no one closes the company and it doesn't end up on your handy dandy company exit tracker on kingscrowd.com. It just sort of exists in perpetuity. And then all of a sudden you'll see I'm blanking on the company right now, that Neopanda, someone, they're now all of a sudden raising capital again. And it's like, I haven't heard from them in forever. Great to see that they're still alive and doing well and now raising capital. They may be doing very well as a company. I haven't looked, but I just think it's funny. This is the kind of space that we live in, and people don't necessarily realize it unless they spend a lot of time in it. The companies will be dormant for years. And sometimes they turn around into something again. And sometimes someone randomly bumps into the founder and buys their brand or their domain or some underlying asset or something for some nominal fee. And you're sort of like, okay, what does this mean for me? And usually it doesn't mean good things for you. Usually you end up with, in my case, just as an example, Early Bird, which I think is a great example of conversation here. Early Bird just sold to Acorns. I love Jordan and Caleb, the founders. They're very good people, but I can't say as an investor I'm thrilled with the way that they portray it. Acorns bought them because they needed capital. They couldn't get it. And I traded $50,000 of my capital into $5,000 in Acorn stock. Not a great deal. It's not really published that way. But it's the only outcome that resulted in somebody getting something. And I think that's the part that we got to make sure we pay attention to here, is like sometimes in the case of Hello Woofy, I only look through the notes that you guys sent over just briefly, but it sounds like they've got an issue on several fronts. There's liquidity issues. There's inability to raise new capital issues. There's no real way for them to keep building the company when they have some $600,000 owed deal. I couldn't tell if that was from an investor suing or what the case may be. Basically, the company is forced, or founder is forced to make a decision. Do I just let this thing hit the wall? If they have a better thing coming, then that's usually what they do. In which case you just end up with the zero, at the end. A lot of times the founder thinks that they have to try to find some good outcome, whatever that might be. If the company's going to stay in business, it usually becomes an asset sale at a very minimal amount of money. Usually, most of the time, in particular for crowdfunding, you're not carried along in that. And to be honest with you, given the accounting hassles and legal fees, it's honestly probably your best interest, because that company is more likely than not going to be successful. And then, of course, there's the circumstances where they do cram downs. And I think what I would say to the investor in this, and then we'll open it up again, the investor in this, I just think you need to have an understanding that sometimes these outcomes take 8 to 10 years to get anywhere. And more often than not, these deals are not going to work out. And it's just a matter of in what way is it not going to work out, and how far you want to chase the deal really should be relative to the amount of capital you put in. There's a certain level at which chasing after these deals or dealing with the accounting headache of transfer of shares and all this. And Brian could talk a lot more about what happens after a sale or post exit, even if it's a shitty exit. There's a certain line where, like, honestly, I'm not even chasing it. Like, I hope that they don't file my thing and the accountant never tells me I owe money. Like, just forget it. That never happened. That is, I think as an investor, sometimes you just got to let it go. On the founder side, I wish I could have more people who are founders listening to this program right now and listen to me well. Not everything has to end in what you think is a perceived positive outcome. Like, for anyone paying attention, everyone knows when it's like a fake exit. It's super fucking obvious. So I wish that the founders would just stop with the, like, we're going to do this kind of a sale or that kind of a sale to, like, save face. Because it really does create a bit of an accounting nightmare and a bit of a pain in the butt for guys, like you, Teddy and Léa and Brian, myself, like, as people investing smaller amount of capital, it really is, like, kind of annoying. But none of that is to say of what's going on with Woofy here, but it is, right. This is a very common occurrence. I guess should have been the 7 minutes I just wasted.
Yeah, I've definitely honestly, I think I've had a couple dozen companies now who will say they had a merger acquisition or an asset sale, but it basically ends up being investors get nothing. Now in this case, again, with Woofy in particular, you could say that the founder is also trying very, very hard to get some value for the investors because they're getting some shares in the acquiring company. But, to that point, it's probably going to be very diluted, much smaller share. And then to Scott's point, if I made $100 investment originally and it's now worth 10%, what's the mental bandwidth and just like my tax tracking for what's worth $10 on paper now?
Last little part of that you just mentioned, the selling the shares and the founder really wants to like carry it over. Again, I'm not speaking about Woofy. This is just my experience in this. More often than not, it's not really even that they want to make sure the founder or the initial investors get something back, because everyone knows the investor is going to be pissed off if he gave you 20,000 and you give him 2. That phone call is not going well, no matter whether it's 2,000 on 20 or 5,000 or even 10. It's a bad call, right? They want to make sure that they're not going to get sued. And in a lot of cases, the existing company wants to just make sure that these people are like carried over in a way that's legally responsible. This is the part of this that kind of drives me nuts in the startup kind of scene here, because there's a lot of pomp and stance. It's not real. It's just sort of like we're going through these motions to make certain things look a certain way. And a lot of times investors, particularly retail investors, just have no idea. So you get this like legal document in the mail and you're like, whoa, what's going on here? And it's like, actually, this is like total bullshit. It's nothing. Like, just throw it in the trash.
Teddy Lyons, any comments?
I think that when we look at founders that are claiming exits, that's one of the things we try to figure out. A lot of founders are going to claim exit, but if it's an asset sale, it's, to me, as an investor, somewhat of a failure. I kind of agree with Brian that it's better to try to give a little bit of cash back to investors and not give them anything, even if that can be a hurdle, a problem in terms of time spent on taxes. But it's just important to be careful and look at, okay, yes, they were involved in an exit, but what was it? Because that one, Hello Woofy, just sounds more of a failure than a success. And so even if you can give credit to the founder if they weren't to want to start another company because they would have that experience, further experience is definitely valuable, but I wouldn't give them credit for an exit on that one.
Yeah, no, I was just saying, yeah, a lot of founders have no shame in saying they're 3 times exited, but they, had asset sales, or there was a fire sale, whatever it might be, an acqui-hire type of situation. But so yeah, always something me and Léa look into a lot when founders claim exits, but without much proof, and try to get that as much as we can directly from founders. So
cool.
So is that the exit for who? The exit for the investor, or the exit for you just got a new job?
It was
that's the stuff that drives me crazy.
Yeah, there was one. Oh God,
I want to find one of those emojis for LinkedIn that you put on your profile that's like acqui-hired, and instead of saying like I exit my company, it's like this is just like really excited. I'm really excited to share with my network that I got a brand new job. Sorry to my investors.
There was one really bad one I saw recently that was. Do you guys know that robotics company that like gave you a manicure in like 5 seconds?
Oh yes, I do. I forget the name of this.
Yeah,
now, but yes.
They said they basically like sent an email to investors saying like they've been bought out. Basically investors are getting nothing, and the entire management team's leaving. But then on LinkedIn, that same founder was like, "Oh, proud to announce the next chapter of this amazing acquisition." I was just like. Dude, I was actually so upset.
It's brutal.
Also, Sam, you can cut that out. This was me on a tangent, but
it's all good.
That's the best content.
So yeah, takeaway here, right? I think it's just that it's not just black and white in terms of outcomes. There's a whole spectrum, and sometimes it's a little bit in the gray area, but that's something that as the industry matures, as investors get more familiar with some of this, I think you'll see more of that. And so we just wanted to highlight that today to be able to share with people. All right, let's wrap up that segment and move on to the deal review this week. So Siren Biotechnology, company currently raising on WeFunder. Pretty interesting. And I know our analyst here, Teddy, is pretty excited about it. So Teddy, why don't you jump into Siren Biotech and what they're doing?
Yes, as you'll see, I'm most excited by the founder. But anyway, so just to kind of give an overview on Siren. So they're basically taking a widely used therapy that has been used for over 30 years to treat genetic disorder, and this is called AAV gene therapy. So this is basically a virus that is exceptionally good at delivering medicine or payloads to precise areas of the body, and they're used to treat single gene genetic disorders. So this is when a patient is missing a gene in their genome, or they have a mutation in their gene. And basically all they need is a functional copy of the gene to go and correct the mutation or the missing gene. And it's used very effectively for the last 30 years to treat things like genetic blindness, muscular disorders, and things like pediatric Parkinson's. And so it's a very widely used therapy. And the beauty of it is it's really good at delivering it to very precise areas of the body, whereas for treatments of other diseases like, say, cancer, chemotherapy rushes through your entire body and kills a lot of healthy cells in addition to cancer cells. So what the founder and what Siren Biotechnology is doing something that has not been done before. There's no FDA approved AAV gene therapy for cancer. So basically using this therapy to treat cancer, specifically brain cancer, which is one of the deadliest forms of cancer with pretty limited treatment options. So what Siren has done is they've developed a universal gene therapy platform that combines elements of AAV gene therapy, like we said, that's kind of the core of it, but also bridges that with immunotherapy, which immunotherapy is when your body, your immune system, is trained to detect cancer cells that it would otherwise miss. And so the way AAV gene therapy works for cancer treatment is it is able to transport things that are called, wait for it. Cancer announcing type of treatment. So they're able to use AAV gene therapy, which has never been used to treat cancer, to deliver cytokines, which basically they're transported directly to the tumor and basically announce to your immune system, hey, there's a tumor here, you should, and it's gone invisible thus far, so you should come and take care of it. And that type of treatment for cancer had never been tried before because AAV gene therapy, as is stated in the name, has only ever been used to treat genetic disorders. That's always what it was thought to only be good for. And because there's no oncolytic virus involved in AAV gene therapy, it was never seen as a viable path to take on a research front. So basically the founder, she had a lab at UCSF, and she's a pretty renowned expert in AAV gene therapy. She's on like 20 different scientific advisory boards, including Sarepta, which is one of a big pharma company. She basically eventually began collaborating with the cancer research department at UCSF and said, hey, like, is it possible that we could work with you to try to apply this very well-known therapeutic that has been used for decades to treat genetic disorders? How can we potentially use that and universally kind of adapt it to treat cancer, not only brain cancer, which is the first indication, but because all the different cancers, a lot of them are very similar biologically, you could potentially use it to treat multiple different types. So anyway, but they're starting with brain cancer. They have completed kind of their preclinical work in mice. They've shown phenomenal animal trials, phenomenal safety and efficacy data there. And now they're at a point where they are moving into basically entering phase 1 of the FDA human trials in January. They have some more toxicity studies to do in pigs and some kind of general laboratory manufacturing practice protocols that they have to kind of iron out and submit the paperwork for. But they're rapidly approaching their human trials. They were given clearance by the FDA to complete a combined phase 1 and 2 trial. So basically do them both at the same time and skip phase 3. And the reason the FDA has this leniency at times with drug development companies is if you're attacking a really rare virus that doesn't have a lot of treatment options and, is seen as a drug that could potentially really help a lot of patients very quickly, they're often a bit more lenient on timelines and size and scope of the actual clinical trials. And lastly, what I love about this company is they're very well venture backed. So Founders Fund, which is Peter Thiel's VC fund, they were early investors in like every major software company you've ever heard of. They invest, I think, if ChatGPT wasn't lying, they basically invested in 6 drug development companies ever. They invest in a lot of kind of adjacent healthcare software type of verticals, but in terms of drug development companies, it looks like they've only invested in 6 ever in 20 years, and they've invested in almost 1,000 companies total. So they rarely back drug development companies, but they led Siren Biotech's seed round. They followed on in the Series A that they closed recently, And this crowdfunding round is kind of an extension of that Series A round. And so it's pretty rare to see a preclinical early stage pharma company with such strong VC backing. And I think it's a real testament to the founder. She works with a lot of these VC firms as kind of a key opinion leader and kind of helping them diligence some of their healthcare investment opportunities, whether that's software or some other VC firms that invest a bit more in drug development companies. She's a kind of a critical piece of their diligence puzzle that they go through. So when she started this company, when she spun this out of her lab, she had no trouble kind of gaining some really serious VC funding. So yeah, it's one I'm pretty stoked on. The founder gave that YouTube video right there. Everyone should go watch that. It's a presentation she gave at the All In conference, which is, I'm sure everyone's heard of the All In podcast. It's kind of a summit that they put on, and the four hosts of the All In podcast were peppering her with questions, and she took them quite well. So
it's a very technical, right, solution what this is. I think you did a good job, Teddy, of kind of breaking it down and explaining it. But for, Scott, Léa, I'm curious, based on your impression of seeing this and in terms of the team and the backers that you see, what are some of your initial thoughts here in terms of the opportunity or other things investors might want to look at?
I mean, I hate to say read the headline, but Teddy should start off with Founders Fund at the top. There are certain, I actually also, Teddy, great job in articulating the whole deal, but also the part about Founders Fund and its selectivity in this. This is one of the things that I would love to see more of. Deals like this that have, it's not just like YC batch 52A 2025. Like, it's like, this is a major fund that has backed unbelievable companies and has been very selective when it does into companies outside of its general scope. I think that Teddy articulated very well what all investors should be looking to as the first, like, quote unquote, smell test. And then after that, you can start digging into this. And, unless you're a medical researcher, some of this information won't even mean anything to you. But I would just like to see more of these type of deals hit the waves where you've got a founder who is well connected, which is hugely important, who doesn't have a problem raising capital, who doesn't have a problem selling and building brand. And she's done all that. So hopefully all the other stuff checks out and it is as advertised, and would be a really cool opportunity for people, I think. Either way, it's exciting. This is like a really kind of a gem of a company to fall into our little world here.
Yeah. Léa, how about first impressions from you?
Yeah, even if it's like a lot of drug development companies, very risky, there's two things that I like. The first is the opportunity. Like Teddy was saying, brain cancer is just very difficult to treat. Actually, there's only 35% survival rate after 5 years of the diagnosis. So that means that is a huge opportunity that needs to be solved. And even if it's risky, the reward, if that were to work, is pretty high. On the study that they actually do on mice, it looks like the tumor disappears in a couple of days. So I don't know if we can expect that for humans, but it's still pretty impressive. And the second thing is that when you invest through equity crowdfunding, most people just don't have the opportunity to talk to founders. Even when we do, there is just a lot of things that we can't really uncover. It's kind of difficult to go visit them in person, and we can't really focus too much on their background. And so it's rare to be able to quickly see that a founder is, a super founder, has a lot of credentials. And so that's very exciting in this deal, because I think that when you back startups, you're mostly backing founders. They're the one that are going to be making the decision. If things go bad, they're the one that are going to be pivoting and trying to save your investment. And so that's very exciting here.
Yeah. And I think, I forget if she said this, Teddy, as part of your notes or something else, but they have 24 months of runway. It's not even like they're in a real crash crunch right now. And you will hear often that the deals that are like most investable are the ones who are like, we don't even actually need your money, right? The reason I think she said that she was doing part of this round a little bit for a bridge kind of plan B in case some of the FDA stuff takes a little bit extra time, but also because she wants to allow and empower people to be able to support their cause and get involved. And so I think I don't know if there's anything else you want to add.
Yeah. It's something I talked with her quite a bit about, in how they're hitting all of the goals that were set out in all the milestones that their Series A investors kind of put out for them, which is basically get to their IND, the investigational new drug application to the FDA, and then they'll raise kind of a smaller Series B to kind of just get them through all of their human trials, and they won't need to raise again. So, like you said, they don't really need the capital, but it was pretty unique that this is a company that, in terms of their capitalization, where their tech is right now, and in kind of what they've negotiated with the FDA in terms of approval timelines, this is a drug that could be available to investors that might have a disease like this, or kind of people in their families. Like, this is a drug that could be available to them like in the next 3 to 5 years. And I think that's pretty rare to see with early stage pharma companies, that especially that we see in equity crowdfunding, because a lot of them don't have this type of capital kind of on their balance sheet. They're usually not this well capitalized, and they don't have a very obvious line of sight into FDA approval. And this is a pretty unique one where like this treatment could be available like quite soon to patients. And I think a lot of their investors are people, whether that's their families or friends that are affected with brain cancer. They kind of really relate to the mission of Siren Biotech, and is a reason why they've had such a strong start on ECF already. Have already raised I think $1.5 million. So in terms of early stage pharma that I've seen in equity crowdfunding, this is one of the most intriguing ones, I think.
All right. With that, I think we can wrap things up. So thank you all for joining us today. We hope that it's been a little bit educational. You've learned something new, and also taking a look at some deals out there that might pique your curiosity. So head over to kingscrowd.com. Make sure you can sign up for our free newsletter. Also get access to all these great tools. You'll get data-driven insights delivered weekly to your inbox. And we'll see everyone back here on next week's pod. Thanks.